name is Munaf. I'm a financial planner at Gradage Mahura Investments. I've been practicing as a financial planner for around 11 years, and I specialize in investment and retirement planning. This is my first of 6 videos that I'll be sharing over the next few weeks, where I'll be talking about tax saving tips at retirement. So if you are approaching your retirement in the next several years, if you're at retirement and will be retiring in the next few months, or if you've already retired, then I feel you'll find value from these videos. Why 6 videos all on tax saving strategies at retirement? Well, the short answer is that I believe efficient, proper tax planning can have a significant impact on the retiree's sustainable income. A sustainable retirement income is an income that will escalate with inflation until the life expectancy of the retiree. Now, is that sustainable income the same as the required income? And often the answer is it's not. And in South Africa, the statistics for retirement savings is quite sad. So often the sustainable income is far less than the required income. Now, when one does their retirement income planning, there are a few things to consider, such as the correct product choice, the appropriate portfolio selection, the riskiness of the portfolio, and the fees, to name a few. But something that is often overlooked, or it's not overlooked, but perhaps there's not sufficient attention given to it, is tax planning. And you'll see through these videos that if one is to take full advantage of all the tax saving opportunities that are available at retirement, then it will significantly close the gap between that sustainable income and that required income. Proper tax planning can really bring those two closer together, and of course that will help improve your quality of life in retirement. So the first tip that I'd like to share is how to reduce the tax on a lump sum payout that you may receive at the point of retirement. This amount could be a bonus payment, it could be shares that vest and pays out as an income, or it could be the most common way, which would be your leave payout. So your outstanding leave days converted into a cash amount and paid out to you as a lump sum. Now, when I explain this tax saving tip, I'll use an example, and I'll use leave payout because that is the most common form of a lump sum payout that one would receive in the year of their retirement. So we'll use an example of an individual. She's about to retire. Her current annual income is 900,000 Rand. And as you can see from the marginal tax rates, this places her in the 41% tax bracket. Now we'll also assume that we've done her retirement planning and she's comfortable to withdraw the 550,000 Rand tax-free portion as a lump sum from her retirement fund. And the last thing we'll assume is that she has outstanding leave days, and these outstanding leave days equate to a cash amount of 100,000 Rand. So her employer will pay her out 100,000 Rand on retirement. So as per the marginal tax rates, this 100,000 Rand will be taxed at 41%. So 41,000 Rand will be the tax payable on this 100,000 Rand leave payout. Now, how can we reduce the tax on this leave payout? How do we reduce the tax of 41,000 Rand? I'll first explain on principle what you can do to save tax, but practically or administratively how the process would play out can vary, but principally I think is the important takeaway here. So what you need to do is simply put that 100,000 Rand into a retirement fund. By doing that, you then get the tax deduction, so you don't need to pay that 41% tax on that 100,000 Rand simply because you've put that into a retirement fund. You can then immediately withdraw that from the retirement fund because it is under the de minimis amount of 247,500 Rand. So that's the amount that if your retirement fund is under that amount, you're allowed to withdraw it as a lump sum. So in this example, you can put the 100,000 in a retirement fund and immediately withdraw it as a lump sum. But because you will be withdrawing that 550,000 Rand tax-free portion, you would have already utilized your tax-free portion. So this additional withdrawal of 100,000 Rand will be taxed at 18% because that's the next tax bracket as per the retirement tax tables. But that's not so bad because you rather pay tax at 18% than 41%. So just like that, as you can see in this example, this individual saves 23,000 Rand. So that in principle is my first tax saving tip for retirement. There are 3 more points that I would like to bring to your attention that are actually quite important to be aware of if you are going to be making use of this tax saving strategy. The first is that to contribute to a retirement fund and get the deduction, the tax deduction, there's a maximum. It's 350,000 Rand or 27.5% of your income for the year. Whichever is the lower of the two would be the max. So if you've already reached your maximum capacity that you're allowed to put into a retirement fund and get the deduction for, then the strategy is not going to work. In terms of implementing, ideally if you can do it via your employer retirement fund, that would be ideal because your employer would transfer the full amount into your retirement fund. They do not need to deduct the tax if they're putting that amount into your retirement fund. So that would be first prize. Alternatively, your employer would deduct the tax, pay you out the after-tax amount. You would then need the liquidity to top that up and then transfer that to a retirement annuity. You will be able to withdraw that immediately, but to get the refund, which is of the tax, so the tax that was deducted by your employer, to get that back from SARS, you would only get that back when you do your taxes, whenever that may be during tax season. So if your employer cannot directly transfer that amount to your retirement fund at work and has to pay you out the after-tax amount, then there will be a delay in how this strategy plays out, but it is still a sound strategy, and if done right, it will save you money. The last thing I'd like to make you aware of is that if the employer has to pay you out the after-tax amount, which means that you'll have to contribute that to a retirement annuity, then in terms of the de minimis amount of 247,500 Rand, be aware that that applies on a provider level. So if you have an existing retirement annuity with a specific company and you set up the new retirement annuity with the same company, then you may not be able to withdraw the lump sum because the combined retirement annuity value is above that de minimis amount of 247,500. So if you have an existing retirement annuity with any investment company, then be sure to set up this new RA for this leave payout amount now with a different provider altogether. So you'll then be able to withdraw that as a lump sum. Alright, that was my first tax saving tip for retirement. If you have any questions or need any clarity, feel free to get in touch. I'll share my next tip within the next 10 days. Till then, keep well. Goodbye.